Hi, folks. This is Dan Bird on Sunday, April the 16th. And Mr. Zuber is not here today, so I'm going to be running this solo. I'm going to do two sessions, however. First one is going to be a market look back, see how we did last week, especially with the CPI numbers. The second session, I'm going to talk about the banks because that kicked off earnings season on Friday. So let's jump into it. Got a lot of stuff I want to share with you guys and cover. Let's start with if anyone's interested in joining my newsletter. I do this every Saturday. I don't monetize it, so I'm not sharing or selling emails or anything like that. This is just something that I was doing for myself and my family and friends. And now that I've joined Mr. Zuber on his YouTube channel, I'm sharing it with you folks as well. So if you're interested, just send me a note to breakpointtrading@gmail.com. That's breakpointtrading@gmail.com. And I'll add you to the list. I'll send you last week's newsletter. And then if you ever want to be dropped off, just let me know. So let's start here. Last week, every week in the newsletter, I put a look back of what happened on the calendar for the week before and then what's coming up for the next week. Calendar last week was very interesting. I'm going to talk about this a little bit more about how the week went. It was a roller coaster week, which is why I put some of these cartoons regarding roller coasters in here. Core CPI came in a little bit higher than previously. It came in at expectations, but a little higher than last month. So it ticked up a little bit. Well, I'll show you the chart on that in a second. So that wasn't great. However, the headline CPI was excellent. Headline CPI was last month was 6%, was forecasted to come in at 5.2, actually came in at 5%. So significant drop in CPI from 6 to 5 in 1 month. So that was really critical. And then crude oil inventories actually ticked up some, but not too much. The FOMC meeting, and I'm gonna show you the chart for the week, and I'll tie all these things together. But the FOMC meeting came in at 2:00 on Wednesday after the CPI, and the Fed was talking about the banking crisis is probably going to cause a recession. That may be true. As I've been saying all along, I don't think a recession is going to happen. I think one probably will happen, but if it does, it will be short and shallow. And it probably will be towards the end of the year or the beginning of next year. But they started talking about it already. So, which is something that I said last year. I said that they would hike rates until they broke something, the banks broke. Then they would start talking more about recession, then about inflation, because inflation will clearly be coming down. And that's what's happening right now. On Thursday, we had a great PPI number. So that PPI made inflation look again like it's really dropping significantly. I'll show you the chart on that as well. So that helped out on Thursday, and then on Friday we had bad retail sales numbers. So it was a real roller coaster week, up and down all week long. Give you an idea of where we are right now. This is from Stock Traders Almanac. So they do research going back 100 years. This goes back to 1950. This is what the markets typically do. This is an average, obviously. Right now we are in this week and we've got options expiration coming up on Friday. Now, when I do the midweek update on Wednesday, I probably will have information about options expiration and in particular, the max pain, which basically is where market makers stand to lose the most money. So they want to move the market in a way that they won't lose that money. I'll talk about that more on Wednesday. I think because we've been basically heading up lately, we probably will have a fairly flat options expiration or slightly down. So it's usually the opposite of what the market has been doing. So if the market's been going up, that means lots of people are buying calls, which means market makers need to satisfy those calls on options expiration. So they would prefer that they expire worthless. And to do that, that means they need to push the market down so that those calls will expire out of the money. So I'll talk about that more on Wednesday. One thing that I really want to make clear, and this is important and something that we seem to always forget or don't focus on a lot of times. The stock market is a leading indicator, and it is probably the best leading indicator. It's usually 6 to 9 months ahead of the economy. So the folks in the market are looking 6 to 9 months ahead, which means before the real increase in rates really started to kick in, the market was already looking ahead that was going to happen. So beginning of last year, 2022, the market started selling off as a result of that. Now the market is looking ahead to the end of rate cuts and possibly even, the end of rate hikes and possibly even rate cuts coming later in the year. So the market is actually going up before the recession happens or before the economy actually bottoms out. So it's one thing with technical analysis. Technical analysis is basically looking at the price action. Price encapsulates within it everything that's happening in the market right now. So rather than focus on things that folks say on CNBC or economists talking about recession or talking about the dollar crashing or talking about, we're heading into a terrible period, rather than focus on that, focus on what the price action is actually telling you. What is the market really telling you? Because the market is looking 6 to 9 months ahead. So this chart, I think, explains it the best. The red area is the stock market. The blue area is the economy. So we're probably right around this area right now. The market is starting to head back up into a bull market, but the economy hasn't quite bottomed out yet. The economy has not reached full recession. But if you wait for a full recession, and even more importantly, if you wait for the recession to be over before investing in stocks, you will have missed half or more of the run in stocks. So always remember that when people start talking about what's happening in the economy or the fundamentals or earnings or things like that, that's fine, but always keep in mind that the market is 6 to 9 months ahead of that. They're looking out 9 months ahead to understand what's going on, and that's what they're buying on right here. So remember that. This is an interesting chart that came from Earnings Beats. Tom Bowley, he does a lot of research as well. And what's interesting about this is he has analyzed what happens from the 26th to the 6th of the different dates within the month, and then also the different quarters, what happens in each quarter. So let's talk about this for a second and intuitively try to understand what's going on here. Keep in mind that most organizations, not all, but most organizations have pay periods that hit on the 1st and the 15th of the month. And most folks today are taking money out of their paychecks to contribute to their 401k. So on the 15th and the 1st of the month, your employer sends that money in to Fidelity or Vanguard or wherever your 401k is located. Fidelity can't just sit on that money. They can't look at the charts and say, hey, I'm going to wait until the RSI looks better or the PPO, the momentum indicators look better. They have to invest that money immediately. So the 1st and the 15th, or somewhere in that range, is when they're going to start investing the money. So what you'll notice is from the 26th to the 6th, from the very end of the month to the first part of the first week of the month, the market goes up on average 21% annualized. From the period after that, 7th to the 10th, it goes down 4%. From the 11th to the 18th, which is the middle of the month paycheck, it goes up 12%. And then the 19th to the 25th, which is when options expiration typically happens, the markets in general, this is since 1950, go down. So how can this help us? Well, first of all, just recognizing this can help you understand if you're a short-term or a trend trader or a medium-term trader, to understand what's happening in the market during those periods. If you're a long-term investor, you might want to look at the down periods as times to get into a position. So if you want to take a position in JP Morgan or Amazon, for instance, maybe you want to wait until these periods when the market is down to buy and just hold it for as long as whatever your length of period is. Now, the quarterly numbers are interesting as well. And what you can see is the first half of each quarter is usually much better than the second half. Q1 is much better. First part of Q1 is better than the second part. First part of Q2 is better than the second part. First part of Q3 is much better than the second part. Q4, interestingly, is pretty much even. Q4 usually goes up in both sections from October till December 31st. So again, just understanding the trends and what happens in the market is really important. And then finally, something that I've always talked about and is an interesting thing to keep in mind and understand is the idea of secular bull and bear market. Secular means long-term. Cyclical means shorter term. So a secular market, and you can see here, there have only been 3 secular bear markets in the last 100 years. That's a period when the market goes down and it does not break out to a new high for a very long period of time. You can see from the 1929 crash right here. This here is 1969 until 1982. That was a long bear market. And then from the dot-com bubble, from the crash in 2001 until 2013. 2009 was the end of the financial crisis, but 2013 was the point where it actually broke out and confirmed that it was back in a bull market again. So that was the secular bear. There have only been 3 in 100 years. There have only been 3 secular bull markets as well. And what you can tell here is secular bull markets is they typically run 18 to 20 years. So each of these runs 18 to 20 years. The 1987 crash in this one, this is the 1982 to 2001 period. 87 crash is this one right here, where everyone thought the world was ending. The market was going down and never coming back. People were talking about another 1929 crash. You can see it's barely a blip now when you look back on it. However, it did take about 2.5 to 3 years to get back up above the peak right here. So even though that big downtrend still did not break the trend line, it still took 2 or 3 years to get back to even. That is very similar to the COVID crash right here. So the COVID crash, if you look at both of these, there's 1987, there's the COVID crash. This one went down right there, went back up, and we may take 2 or 3 years to break out of this again, but I believe that we are still in a secular bull market. 18 to 20 years takes us to 2029 or 2023, somewhere in that range. So we still have a good 6 to 7 years left in the secular bull, which is why I think we are going to go back to the highs and probably break higher than those highs. And you can see that the chart above up here, I'm going to show you one that's a little bit clearer and shorter term. So always remember this secular bull markets. You can also always tell down here, you can tell the RSI as well. During the bull periods, it never goes below 40. During the bear periods, it gets below 40. And then the rate of change, this is a 12-month rate of change down here. Again, it never gets above this level. Actually, when it gets to this level, that's an extreme level. So that's typically where markets will start to recover. So remember that, and I'm going to show you the next chart right here, which is a closer look of the current secular bull market that we're in. So you can see right here, 2013 is when it broke out. 2009 is really when it started. It has not gone below this trend line. This is a moving average, which is basically the 200-week moving average. This is a monthly chart, by the way. So it's never broken down below that. Even the COVID crash, even though it went below it, it never closed below it. So it went down and came back up and closed higher. We touched it again in October, and now we're starting to trend higher off of this. Same with the PPO, the momentum indicator up here. Notice how it's starting to hook back up right now. We would like to see that continue to go up. If it breaks below this, then this becomes red, and then we're out of the secular bull market. Same with the RSI. RSI comes down and hits 40 right here and then bounces up. And we did that in October, and we're starting to head higher. So again, this is just confirming, and this is, I've had people ask me, when will you relent and say we're no longer in a secular bull market? Well, as soon as one of these indicators turns red, then I will say the warning sign is on, that we're probably exiting the secular bull and maybe heading back to a secular bear market. But that hasn't happened yet. We'll keep an eye on this though. This is what the S&P looks like right now. This uses quadrant lines and Fibonacci's. In fact, let me move this back 1 month and you'll see the quadrants better. So these are the blue ones are the quadrants. So right now the 50% line is half the distance between the COVID crash and the high in 2021. So between those two periods, these are the quadrants. The 50% level is exactly what we hit, almost exactly, right there, 3,500. We went to 3,491, and we bounced from there. The next quadrant line is up here, which is exactly where we are right now. So we've actually come up here a number of times and tried to get through it and haven't. And then the Fibonacci levels, again, the anchors on this are the bottom of the COVID crash and the top in 2021. The 38.2% level, which I've been talking about a lot, is where we have seen significant support. The market's come down to that and gone back up. And then this area in here that I've shaded is a significant resistance level. We've got the 4,100 level that we have to get through. We've got the 75% quadrant line. We've got the 23% Fibonacci line right there. And then we've got the resistance at 4,300. So there's a lot of congestion right in this area. And what I've been expecting is for us to get up in through here and try to get through it. But the bears are going to come in here. The bears are going to say, this is the resistance. This is where the market starts heading lower again. And they might be right. So we'll have to watch it. Well, if they start selling, which I expect the bears probably will do, then we may bounce around in this area for a while. But I think that we are going to eventually break out of this 4,300 level. When, I'm not sure. I think we've got some critical issues coming up, especially with some of the inflation reports. I'll talk about that here in a second. So here's a closer view of the S&P, where we are right now. And what you can see is first of all, on this longer term view, you can see that we actually made some nice progress last week. So this is a weekly chart. So last week, even though it might not have felt that way, because we bounced around a lot, we actually went up last week. Week before, pretty much stayed static. It stayed right where it started. But last week, we actually made progress. But on Friday, we had this indecision. That's called a spinning top doji. So the market went up, the market went down, and the market ended right back where it started. So that's indecision. The market's not sure yet. It's hitting a resistance level right here. It very likely could head down. Mondays are typically not good days, and next week is options expiration week. So as I said, since the market has been trending higher, lots of people are buying calls. So market makers at expiration probably would like to see the market go down so that all of those calls expire worthless. We'll see what happens. But that's significant resistance right there, and that's what we have to get through next. So we'll see if that can happen. This is what it looked like, and this was in the newsletter that I sent out this weekend. I thought I'd just take a look at the whole week and see what the week did, because there were so many things going on. So you can see the week went up in anticipation of a good CPI number. Monday and Tuesday were higher. We got the CPI on Wednesday morning. The core CPI was a little bit worse, but the headline CPI was much better. So we gapped up in the morning, came back down and tried to make a run again, went down and came back up again. But then the FOMC minutes came out where the Fed was talking about inflation and the banking crisis, and probably not inflation, but recession was probably on the horizon. And the market sold off as a result of that. And then on Thursday, we had a great PPI. Now, the forecast for PPI was actually for it to be worse. And instead, it came in much better than expected. So in this case, the positive PPI sent the market higher again. As you can see here on Thursday, we traded up. But then on Friday, we had poor retail sales and the market sold off again and then tried to recover in the afternoon. Now, if you look from the beginning of the week to the end of the week, we did make progress through the week, but it was a roller coaster ride through the whole week. Now, one of the things in this chart for those that are interested and those folks that are like to study or are thinking about studying technical analysis, I have a couple of things on this that I'm actually putting now on my standard chart. The red and the green areas here they're called chandelier exits. So it's a calculation that's built. You can look this up. You can search for it or look on Investopedia. Chandelier exits are a good way to set a stop. If you don't know where you should set your stops, then chandelier exit might be a good way to do it. So the green line is for longs. So in other words, if it sells down to that green line and closes below it, then you should exit the position and get out. The red one, on the other hand, is for shorts. So if you're short something, and that's where your stop will be, in that case, when it goes above that line, then you want to get out of your short. And to get out of a short, you have to buy. And to get out of a long, you have to sell. So what this does is it kind of gives me some areas to watch. So in this case, I put a little green arrow here because not only did it go above the long, the green one, but it went above the red one as well. So the way to think about that, if there were shorts in this case, it's the S&P, but it could be anything. If there are shorts here, then they want to get out of their position when it goes above that red line, which means they have to start buying, which is just going to add to the buying. And that's what happened here. So the market went up. And then as this comes down, if it goes through the green one, first of all, it goes through the red one. So that's good for the shorts. But if it goes through the green one down here, then the longs want to sell to get out. So that's why I put this red arrow. So that's a down. This is a buy to get back in. When it goes above the red, when it goes below the green, then you should sell to get out. And then it goes above. This is for short-term traders, clearly. If you're a longer-term trader and you want to use this technique, then you would use a much longer time frame chart, either a weekly chart or for really long-term traders, a monthly chart. But the same concepts would apply. So here is an exit right here. And on Friday, this is a 15-minute chart. So these are 15-minute bars right here. So on Friday, we got a buy signal again. So that implies that we could go up on Monday. We'll see what happens. Next thing is we'll look at the trusty VIX chart. VIX is looking really good. The VIX keeps going down. So we closed on Friday at 1812, just above 18. When the VIX goes down to 17 or so, I mean, it's clearly in an uptrend. And usually a bear market does not last if it goes below 17. And it's continuing to go down right here. So you can see the S&P going up. We're getting close to a resistance line. Put call ratio is kind of static. And then the number of stocks above their 50-day moving average is starting to climb, as well as above their 200-day. So all of this looks very positive in the medium term. In the short term, we'll have to see what happens next week with options expiration. All right, so let's talk about CPI and what happened this week. So this is a chart of the headline CPI. And the way CPI is calculated is it's on a 12-month rolling window. So every time a new CPI number is reported, then an old one drops off. So what you can see here, if we go back 12 months, this is a monthly chart. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So that's the window that CPI is looking at right now. What that means is this big one right here dropped off in this recent report. And that's one of the reasons why the headline CPI looks so good. You can see down here, this is the rate of change over a 12-month period. So this is the rate of change for headline CPI. You can see it's coming down significantly, but core CPI went up slightly. So you can see it gapped up just a slight little bit. it started to curve up just a little bit right there on core. But because this big one dropped off, that's one of the big reasons why we had such a great headline CPI, why it went down from 6 to 5. Now, the thing that concerns me is this next one for next month. You can see how small that one is. So there's going to be a very small one that drops off next month, which means it actually could end up looking worse. So I'm afraid, and the next chart I'm going to show you kind of verifies this as well. I'm afraid that the CPI report in middle of May is going to be worse than expected, making it look like inflation is starting to head higher. I think the Fed is probably going to raise another quarter point, May 3rd, but that will be before the CPI number. And then we may get a bad one. But after that one, look at the next two. The next two are huge. So the June and the July CPI report are going to show inflation dropping off a cliff. I wouldn't be surprised if we're below 4% in the July report. It's also about the time when real estate, when rents and everything start getting reported, which those will be coming down as well. So I'm expecting by midsummer, inflation is going to look like it's actually dropping off a cliff. Here's the PPI. Again, you can see PPI, and this is the 12-month window here. PPI dropped as well. It was actually forecasted to go up, back up to this level here, but instead it went down. And it's got three huge ones that are going to drop off. So the next 3 months for PPI, even though CPI might not look too good, I think PPI actually is going to look pretty good the next couple of months. So keep an eye on that. And then this is the inflation chart. This is another reason why I think the next CPI report, inflation report, is not going to look too good. So the one that was just reported is inside this shaded area, and most of what they report on is the first part of the month. Back here, you can see there was a huge decline. CRB, commodity resource, and then gasoline, oil, and lumber all had declines, especially in the middle of the month where the report really is focused on. So that's another reason that contributed to having such a great inflation report this past week, because those were declining so much. But look at what's happened since then. They are starting to tick back up significantly. In fact, the CRB is back above the level it was back in February, mid-February. So that's this first half of the month is primarily what the next one is going to be reporting on. So that combined with the small CPI that's going to drop off, I think is going to make the inflation report not look too good for the next one. So that could cause the market to go down again. And then finally, this is the last thing I'll show you here on this session, is the put call ratio. Now this is a 12-month put call ratio. So it's 253 days, which is how many trading sessions there are in a year, 253. The way to interpret this is a put call ratio. So if people are buying more puts than calls, meaning they're selling, they're negative on the market, then this will go up. If they're buying more calls and fewer puts, then this will go down. So if you'll notice what happened here after COVID, when everyone that you know was buying stocks, you had the folks on Reddit, meme stocks. I mean, the market was going crazy. You buy anything, it would go up in 2020 to 2021. And that's reflected with the put call ratio. So because it went down, that means everyone was buyers. In fact, you can see here, it got down to a well below a 20-year low. This is the 20-year trend line up here. It crashed way lower than that. So basically, when we got down here at the end of 2021, and one of the reasons why at the beginning of 22, one of many reasons why at the beginning of 22, I had said that the market is probably going to be going through a period of decline for quite a while. I thought at least 6 to 9 months, but it's been probably closer to a year. But one of the reasons was this: everyone was buying. Down here at the bottom, there were no more buyers left. So people weren't selling yet, but there just weren't any buyers left. And then the beginning of 22, for a number of different reasons, folks started to see the market decline right here. So the number of puts started to ramp up. So this basically is sentiment. Sentiment was extremely bullish through 2021 to the extreme. Whenever you get extremes, that's a good time for everything to reverse and go the opposite direction. And that's what happened in 22. It reversed, the market went down, you can see right here, and the number of puts started to skyrocket again. Now look where we are right now. The put call ratio is the same as it was in 2016. That's how high it is. So now we have the opposite situation. Now we have more sellers than we have buyers. In fact, we are getting close to a point where there aren't any more sellers left. So it won't take very much for this whole put call ratio to start to reverse. And remember, when it goes down, the market shoots higher. And it could very well be when we break through this congestion right here. So if we can make it up through 41, 42, and then 4,300, I expect there's going to be a lot of bulls and bears battling it out in this area. But if we make it through 4,300 right there, then watch out. I think this is going to reverse and start to trend lower, and the market is going to shoot higher. So keep that in mind. We'll see if that happens. All right, that's it for this particular session. Let me show the newsletter one more time. For those that are interested, just send me an email to breakpointtrading@gmail.com. And in the next session, I'm going to talk about the banks, and we'll take a look at some of the sectors, what the sectors are doing. We had 3 of the big banks reported on Friday, and we've got Bank of America coming up on Tuesday. It's very interesting. I actually made some predictions on that. So we'll talk about that in the next one. All right. Thanks for listening, and I'll talk to you soon. Take care.